Great. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape? Yeah. Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, you know, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
That was Chairman Powell wrapping up the news conference, and we are go in this equity market from New York City this afternoon. Good afternoon on TV and radio. This is our coverage of the Fed Decides. Look at this. Your equity market's absolutely flying on the NASDAQ, on the S&P 500 up by 2.7%, on the S&P, on the NASDAQ up by more than 4%. Treasury yield shaping up as follows. We take a dive at the front end of the yield curve, down 9 basis points on a 2-year to 297. On a 10-year, we're lower by 4 basis points to 277. And echoes of the ECB and President Lagarde at a meeting last week. Forward guidance is dead. Take a listen to this.
We think it's time to just go to a meeting-by-meeting basis and not provide, the kind of clear guidance that we had provided on the way to neutral.
That non-committal stance, Tom, seemed to trigger this idea that peak Fed hawkishness is behind us.
Yeah, no question. I did some work here, John. The NASDAQ move we see is back 16 months to a lonely day in March of 2021. The forward guidance is gone, John, but what I really saw there, and particularly a poignant moment, 2/3, 3/4 of the way through the press conference, where it seemed like a very tired Jerome Powell sort of stepped back, is John, is with great respect for their public service, they're making it up as they go. That's the new forward guidance.
Been making it up for a while, Tom, and we'll hear from him and Jackson Hole, hopefully. Bramo, what is it about Fed days? March 16th up 3.7% on the NASDAQ, May 4th up 3.4%, the NASDAQ 100, June 15th up 2.5%. Today, where are we now? At more than 4%.
Yeah, you did a great job on Twitter. What happens then the day after?
Well, the last 2 meetings we've found pretty dramatically so.
I mean, how much is this basically the market not getting it right, not Fed Chair Jay Powell, because the market took a listen to what he said, no forward guidance. They're going to go meeting by meeting, data dependent. They recognize the softening, but emphasize the strong labor market, inflation #1 goal, and somehow this is dovish. Somehow this means they're going to back away sooner. Perhaps you could read into his comments that at some point they'll retrace some of their rate hikes, but that's just logic. I mean, at some point they will come back down. I mean, it could be 2035, right? I mean, that's just logic. So it's interesting to me that people just want to buy, and they're going ahead with it.
We're going to be highly sensitive to incoming data, much more so now. And not just the CPI report, but also the labour market report. And if you want to blend of both, look for the ECI. We'll get that later this week as well. Tom, if you allow me, just give me some time to go through these quotes from Chairman Powell. These rate hikes have been large, and they've come quickly. And it's likely that their full effect has not been felt by the economy. There's probably some significant additional tightening in the pipeline. That's what he said in the news conference. Pair that quote with this one. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Tom, it's what he didn't say. It's what we heard in the previous meeting.
No,
it's the lack of commitment to going big, which is reinforcing this move, at least for now, to Bramo's point, I think we've got to recognize on Fed days, do not define the Fed decision by the price action of the day, because the following day over the last couple of meetings, Tom, have been very different.
This is absolutely profound, and it's around what I call a type 1, type 2 model. And the type 1 model is basically what you say, what comes out of your mouth. But you're absolutely right, John. What's so important here and what gave sustenance to this market going into the Apple-Amazon soiree tomorrow, what's so important here is what he didn't say, and that pulled away from the, with respect, stridency that we hear for someone like Dr. Dudley.
I would love for someone in that news conference just to tell him where the market is trading based on what he's saying at some point in the future. Mike McKee might be that man.
Why doesn't he have a Bloomberg terminal at the podium?
Mike McKee's going to ask him next time around. Mike McKee's with us now. Mike, what did you make of that?
Well, I had a Bloomberg terminal at the podium, but I didn't ask him about that. I think the key takeaway, if I can sort of put it in a story form, is that the Fed knows where it's going, but it doesn't know where it is yet. They know that the economy is slowing, which they want. They know that inflation may be coming down, but they can't be sure of that. They don't think that we will go into recession because the labor market is so strong, but they can't prove it. So at this point, they're just going to take a step back, wait and see. He didn't rule out 75 basis points, but he didn't say that was the base case either. So basically, he's trying to give them as much flexibility as possible until they can read the map and figure out where they are.
Michael McKee, a lot of the charts that we're looking at, maybe a 2-10 spread is the best, is they look like a CCM 5 stripe from Lohr. They look like a hockey stick with a sharp bend. Is that because this chairman decided not to be Chairman Volcker this afternoon?
No, I don't think so. You could read it one of two ways. You could read it that way, or you could read it that the Fed is determined enough to tackle inflation that the market thinks inflation isn't going to be the problem going forward. So at this point, though, I wouldn't look at the reaction today to what Jay Powell said. I mean, people had positions on, they have to react to it. Wait for the next 2 days when we get some data that will really matter on growth. And it's not the headline, Tom, it's the composition, whether business investment slowed, as Jay Powell said it was, whether consumer spending is slowing significantly. And then we'll look to the ECI. He brought that up as a major indicator to see where we are with wages. One of the key inputs to the NBER's decision on whether to call a recession is whether incomes, less transfer payments, they take out government payments like unemployment insurance, whether that's continuing to rise. It's been rising strongly. If it's still going up, it suggests that there's still momentum in the economy and we're not in recession.
Michael McKee, thank you so much. Right now, with our interview of the day with a former Fed official, without question, William Dudley is that, Bloomberg Economics Senior Advisor, the former president of the New York Federal Reserve, and of course for years with Goldman Sachs. Bill, I thought of you when we saw forward guidance exit stage right today, and I went back to Dudley and McKelvey. What will our world be like without forward guidance?
People are just going to have to parse the economic data a little bit more and think about how that economic data is going to affect how the Fed behaves. I mean, I think Powell made it clear today that they think that they've reached an important point where monetary policy now is broadly neutral, but that doesn't mean that they're going to stop. He also said that policy needs to be made moderately restrictive. And I think the rally that we're seeing today is just a relief rally that happens most of the time when we have these Fed meetings because the risk event is over. You know what's actually happened, and so people can breathe easier, and so people put risk on after the meeting. I didn't really hear his comments as dovish. He kept coming back to the June's summary of economic projections. And if you look at the summary of economic projections, that's ending the year at 3.25% to 3.5%, and with another 50 basis points of tightening in 2023. That's quite a bit more than what's priced into the markets today. So, the fact that he came back to the June SEP projections 3 or 4 times in his remarks suggests to me that the Fed thinks they're going to do quite a bit more than what's priced into markets today.
Bill Dudley, a rude question, which is for market economics, but with your public service, I'll take a chance and ask you, where is your terminal rate? In the parlor game of 3-ish up to Citigroup at 4-ish, and even our Adrian Wong of Bloomberg Economics up near 5%, where does Bill Dudley's terminal rate rest?
It'd probably be like 4-ish. I mean, I think that's what's going to happen is that there's going to be a lot of ambiguity about whether the Fed has done enough. And as Paul made it clear in his press conference, the risk of doing too little are quite a bit greater than the risk of doing too much. And so the Federal Reserve is going to probably overdo it a little bit because they have to be sure that they're going to be successful in getting inflation back down to 2%. So I think that what will happen is they'll stay, they'll just keep tightening for a bit longer. They'll get to a higher terminal rate. One thing I would maybe disagree with a little bit with Chair Powell is he's pretty confident that they're at neutral today. I think there's a lot more uncertainty about what the neutral federal funds rate is. As he himself has noted, the federal funds rate passes through financial conditions, and there's a lot of variability between the federal funds rate and the impact on financial conditions. So to say that the Federal Reserve has arrived at neutral already, I'd be a little bit more skeptical about that.
It's not gospel just because they say it. Bill, you're dead on. You're right. And you introduced financial markets too. Bill, you're not at the Fed anymore, so you can tell us what you really think about what's happening in financial markets. Equities bottomed the day after the last Fed meeting. Yields topped the day before it. What do you make of the easing of financial conditions, and how do you think they're going to respond to it?
Well, I think the important thing here to recognize is the Fed wants financial conditions to be tighter because they want to slow down the economy to generate more slack in the labor market. That's what Paul said today. So, any significant easing in financial market conditions is incompatible with what the Federal Reserve wants to achieve. So, if financial conditions ease, then the Fed, all that means is the Federal Reserve is going to have to tighten monetary policy by more to get financial conditions back to where they need to be. So, I think that the upside for the markets are very much capped by the fact that the Federal Reserve needs tighter financial conditions to generate the slack in the labor market that we don't have today.
So, Bill, out of interest, what would you characterize as a significant easing of financial conditions? Is it the 100 basis point of tightening we've had back into high yield spreads? Is it the rally we've seen in the equity market so far? Is it more? Is it less?
Well, I still think financial conditions have tightened quite a bit over the last 6 months. But if the markets were to, say the equity market were to rally another 5 to 10% from here, I would view that as sort of undermining what the Federal Reserve is trying to accomplish.
Wait, Bill, I want to just emphasize that. I was stuck on that. 5 to 10% rally in the stock market, and the Fed's going to come out and perhaps talk it down. What about in the bond market? Because what we've seen is a complete rally, particularly on the short end of the yield curve. Are they going to try to talk this back too and say, guys, you've got this all wrong. We're going a lot further than you seem to be thinking?
Well, I think the Fed doesn't want to, provide a lot of forward guidance about what's going to happen longer term because they just don't know because the economic outlook is so uncertain as you get beyond six months or so. And Powell actually talked about that at the press conference that, the uncertainty, the market has this very strong view that the Federal Reserve is going to stop, tightening, sort of at the end of the year, and then they're going to start easing in 2023. And I think Powell was basically trying to pour some cold water on that idea. We just don't know at this point.
Lisa's smiling, Bill, because you said maybe another 5%, and we're right there now, aren't we, on the NASDAQ, Lisa?
And basically that's what we're seeing right now, which if that's going to go counter to what they're looking for, they're going to have to come and talk down, perhaps.
Hey, Bill, awesome, as always. Bill Dudley there, the former New York Fed president. TK, here's your rally, up 2.9% on the S&P 500. On the NASDAQ right now, up 4.4%, call it 4.6%. Yields lower at the front end of the yield curve. Your 2-year down, 7 basis points now?
Yeah.
Down 7 on a 2-year, on 10's down 2. I remind you of something Bill Ackman said in the last 24 hours, and I'll adjust it just a little bit. I'll paraphrase. The more the market believes the Fed will immediately pause, the less effective raising rates will be in moderating inflation, and the more the Fed will have to raise rates. Bill's kind of going in that direction there, Tom.
Yeah, absolutely. He's going in that direction. I'm not going to participate in that. I think it's absolutely original territory, and the chairman alluded to that, I think, with some, as I said, real emotion there 2/3 of the way through. Always emotional. It's Jeffrey Rosenberg, chiseled in the statistics and mathematics of Carnegie Mellon, and joins us with BlackRock this morning. Jeff, I just got to ask an emotional question. That looked like a tired Chairman Powell. His head is spinning. Give us some clarity. What did he accomplish?
Well, as the earlier comments were just talking about, he may not have accomplished as much as he was hoping, as he refused basically to answer the financial conditions tightening or easing question. He kind of referred to the SEP, and that was really his opportunity to do what we were just talking about, really talk back the market's expectation for the pause, the rally. And he didn't take advantage of that. Instead, what he gave was a signal that they're at neutral, a confident signal that they're at neutral. I totally agree with Bill Dudley on questioning that. That's an implicit forecast about where inflation is going, and a very confident forecast about where inflation is going, to say that you're at neutral, and that they could slow the pace of tightening. And I saw the market kind of take off after that. And yeah, this is problematic because the easing of financial conditions undermines what they're trying to do.
You studied under Alan Meltzer at Tupper at Carnegie Mellon, and he was the one that was most experienced on a restrictive Fed. Do you and BlackRock believe we will have a restrictive Fed, and what will that do to fixed income instruments?
Well, you know, the good news on fixed income instruments is we've come a long way. And part of the rally in the 2 years, Lisa was pointing out, is because you're pricing out, you know, more of the fear of even a more restrictive move. So a lot of the expectations of where the Fed is signaling they're going to get to 325, 350 is in the bond market. So the impact on prices going forward is going to be much less, as long as, that's a conditional statement, as long as inflation proceeds along the Fed's forecast and the market forecast. So that remains the big uncertainty. But there's a lot of certainty reflected in bond markets. There's a lot of certainty reflected in the Fed's comments that, you know, inflation is going to proceed along that path. And if it does, then the impact on bonds will certainly be a lot less than it has been year to date, because we've done a lot of that work already.
Jeff, the incoming data, we are going to be so sensitive to the incoming data. Jeff, which data points are you going to be really focused on? Not the obvious ones, CPI, payrolls. What else are you going to be really focused on in the coming months ahead of September?
Yeah, I mean, really this week, as was already mentioned, you know, ECI is very, very important. This concept of wage price spiral, you know, are we seeing that in the data? That's an important data. The labor market's slowing. Jonathan, I think you mentioned at the top of the show, you know, having said, you know, outlined labor market strength, you know, sort of sets that up as the change in the economic outlook that'll drive this expectation for a slowing to show up. So I think those are going to be, you know, key data points around the labor market, alongside, of course, the trajectory of this expected slowdown in core CPI. You know, we expect to get it on headline because of the energy movements, but really the core PCE, core CPI
It's a big day for earnings. Both Apple and Amazon reporting. We'll get in-depth analysis from James Chuckbach at Clockwise Capital.
And Francis Katzen of Douglas Elliman joins us to tell us what's happening with the housing market.
Ultimate level. You know, the Fed is still talking about getting back to its pre-COVID 2% level. We've got a long way for that to show up, and so we're going to be talking about that trajectory of slowing. And the September meeting is just going to get a lot more interesting because there's going to be a lot more conflict with the growth side. You know, we kind of dodged those questions today in terms of recession. 2 more sets of data, monthly data series, is going to be a lot harder if we start to see, as is projected, you know, the slowdown really starting to kick in. Mike McKee, you asked a key question. He didn't answer it. What about the lags in the economic data? That's going to start to show up in September.
He never does answer it when Mike McKee asks the question.
It's always the case.
I mean, Tom, what's new about that? Lisa, are you hearing what I'm hearing? And I hate it. Are we going to be looking at weaker labour market data and saying bad news is good news?
Maybe, although what we heard from Fed Chair Jay Powell was that some of this is by design. When is it not by design? When is it not going to help inflation get lower? And to that point, there is an issue of how is he going to be highly confident that they are on pace to get inflation to 2%? Jeff, this was one of the most underplayed moments of the press conference when he said that they will only stop or pause when they are highly confident that inflation is on track for that 2% goal. What will it take? He's not going to answer 4% or 3%, but what are you looking for to be confident that inflation is well under control?
Yeah, it's the trajectory. It's the 3-month annualized trajectory clearly pointing downward. You know, it's the same way that we've gotten so riled up about inflation reaching peaks. It's because the path of, you know, 2 data points and then three data points creating a very clear upward trajectory. They need to see, you know, 3 months in a row of it going in the opposite direction, seeing the end of the broadening of the inflation story and really seeing the benefits of the year-over-year comparisons coming through, but more than that, really
it's a big day for earnings. We hear from both Apple and Amazon. We'll get in-depth analysis of those results with James Jack Market, Clockwise Capital.
And Francis Katzen of Douglas Elliman joins us to tell us what's happening with the housing market.
Built into most of the expectations. Chair Powell cited the confidence in the tips market that's reflected there. So everything's sort of set up well along the consensus expectations. Now we just need to see it validated in the data, and we've already seen that surprise markets and consensus forecasts on the upside. We'll see whether or not it validates those expectations on the downside as we proceed here into the fall.
Jeff, you'll hate this question, but it's a yes or no because I'm out of time. Yes or no? Would you fade this market move this afternoon?
Yeah, this market move is the victory of hope over experience. So, I'd be a little bit cautious here. The market is, hanging on the slowdown in the pace and not really contemplating as much that the more the markets rally here, the harder it is for them to continue, while the Fed is still looking for that essential slack that he talked about. And so it's going to be a little more ways to go here before this is
Jeff,
the story.
It's the longest yes ever. Come on,
I
Jeff.
didn't answer yes or no.
I got Caroline Hyde standing by. I heard yes, all right? Jeff Rosenberg there.
100%.
That was a yes, Bramo. Come on.
The market is trading on hope over experience. Everything you need to know.
That's all you needed to know. Coming up at the close, Caroline Hyde. Looking forward to it. Caroline, what have you got?
Well, all you need to know is that we've got a guy who has assets to allocate. John, $325 billion in assets under management from this one. Scott Minerd, of course, CIO over at Guggenheim. His reaction to the decision, his reaction to whether this fade this market, his reaction to stocks, to bonds, to Bitcoin. Does he see a recession like Fed Chair Powell does not at the moment? And then the micro, John, because we've got the macro perspective, but what about Meta? What about Ford? What about these companies that have been citing a slowdown in their hiring? We get earnings after the bell as well.
Looking forward to it, Caroline. As always, wonderful. Going into the close with Caroline Hyde and the team and looking for earnings from Facebook. I just can't do the Meta thing, but you all know that. Anyway, TK, this market's ripping. Big tech is flying. The Nasdaq's higher by a whole lot more.
I'm going to dovetail two things here with the time constraint we've got right now, John, and what's been a great show. To our booking team, thank you so much for the intellect that we've seen across surveillance today. John, I'm going to cut to the chase. This is a Fed doing original economics. None of this is in the textbooks, and I say that with great respect for their public service. And then I would dovetail it with corporate officers living in the nominal space who are making it up as they go, and what they're saying is, we will adapt, we will adjust. That's what we heard from Google. That's what we're going to hear from the other companies forward.
Lisa, final word.
My final word is that Bill Dudley's comment that the Fed is basically capping the potential gains on risk assets and that a 5 to 10% rally in the equity markets would undermine what the Fed is trying to do really raises some questions about the moves in the markets and really raises some questions about the interpretation. I'm really watching that.
I'll say what I've said over the last 6 months repeatedly. Never define a Fed meeting by the intraday price action. We are going to be so sensitive to the incoming data.
Tomorrow.
With Tom Keene and Lisa Bramett, I'm Jonathan Ferro. For our audience worldwide, this was The Fed Decides. We'll see you tomorrow morning for Bloomberg Surveillance. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 14 minutes to go ahead of the closing bell. With the Dow, the S&P, and NASDAQ all surging. A Fed Wednesday with the S&P now up by 112 points, up 2.9%. The Dow's up 520, up 1.6%. NASDAQ surging 495 points, an advance right now of 4.3%. 10-year yield, 2.78%. The 2-year yield, 2.97%. Gold up 1%, $17.34 the ounce, while West Texas Intermediate crude is up 3.5%, $98.33 for a barrel of WTI. Bitcoin surging 8.8% right now, 22,837 on Bitcoin. So stocks are rallying, bond yields are falling after Fed Chair Jay Powell said the Federal Reserve will slow the pace of increases at some point. Here was the Fed Chair speaking at the press conference.
The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
And this headline from the Bloomberg Professional Service, Rivian reducing its workforce by 6%. That word from the CEO in a memo to staff. Rivian shares right now are up by 1.3%. After earnings, Google surging 8.3%, Microsoft rallying 7%, Texas Instruments up now by 6.8%. And after the bell, lots of earnings. We'll be keeping an eye on Meta Platforms, shares surging now by 6.2%. One more big mover today. Chipotle Mexican Grill up now by 15.5%. We've got the CEO coming up in roughly 20 minutes right here on Bloomberg Radio. Recapping Fed Wednesday, stocks rally, S&P up 114, up 2.9%. 10-year yield, 2.78%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, we've got just under 12 minutes in the trading day. It's been a big day. It's a Fed day. You heard Charlie break it down. We've got stocks just hovering off their best levels of the session. So we've seen quite a rally. It looks like investors reading what we got from the Fed as kind of dovish signals. We'll see if whether or not the analysis is truly that. We did see yields back down a bit.
And we'll see what happens tomorrow and, Friday.
The day after is often very
different
and very telling.
Plus, we get so much economic data later this week.
It's a good point.
Let's get into it with Randy Watts, who's Chief Investment Strategist at O'Neill Global Advisors. Randy joining us on the phone from Miami. Randy, how are you?
Hey, it's great to hear both your voices, and I hope you're well, and I hope we can do this in person at some point this fall.
Fingers crossed.
Hey, let's go to Miami, Carol.
We'll come your way.
Yeah, that sounds pretty good, especially when it starts to get cool up here. Hey, Randy, just give us your immediate reaction to what we just heard from Fed Chair Jay Powell. I know you watched the technicals here, but give us your read on what he had to say.
I think what happened today was exactly down the middle of the fairway. It was very anticipated. You got the rate increase that the market expected. Market had expected a 74% chance of a 75 basis point increase. Today, you got that. And if anything, I would say the press conference was slightly more dovish in that Powell made it very clear the Fed's going to be data dependent going forward. But he also sort of reemphasized the 3.4% rate for Fed funds for the end of the year. So I would say exactly as the market expected, no surprises, slightly more dovish press conference. And that's one of the reasons equities have reacted so strongly, and I would note bonds have rallied as well. The curve has flattened somewhat with the 10-year coming down with the 2-year coming down a bit. So really as expected.
Yeah, and I think also, Carol, it seems like that investors are pretty happy that Jay Powell said that we're not currently in a recession right now. I mean, reporters tried really hard to get that question out of him. Neil Irwin over at Axios finally did.
Right.
And we saw stocks move higher after that.
And he reminded everybody, hey, wait, that's not my responsibility. It's all about my dual mandate.
It seems like there's a single mandate right now, and that's inflation.
Well, exactly. I have to say, Randy, when he said that, wait a minute, we could also, start to think about slowing in terms of our rate moves. I thought, to me, that's very significant. But I think you were spot on. Bill Dudley, formerly of the New York Fed, the same thing. Jay Powell reminded us several times through that press conference. He came back to that June dot plot, which shows, a commitment by the Fed to continuing on its tightening path. And I think that needs to be something that investors kind of just remember that he said that.
If I could add one more thing,
sure.
I'd say the other sort of important points are he did say that he's seeing slowing demand in Q2. They did say that they're going to try to stick to the balance sheet drawdown that they're currently on, and that they were aiming for a soft landing, but that's very hard to achieve, and that they think it's necessary to slow growth. So, I mean, the Fed is definitely still in a tightening cycle, but again, at the margin, slightly more dovish than I think what people most feared from that press conference.
All right. So as investors then, like, help me out here, because I'm kind of tired of all of the speculation. We've hit bottom. We've not hit bottom. I mean, if you're investing in this market, you got to figure out how to put money to work. Should you be putting money in the equity universe? Should you be playing it safer in fixed income? How do you see it?
Okay, let me say two things. First, I think the minute the stock market can identify or see, we don't have to be there, but can see the end of the Fed tightening cycle, I think stocks are headed up a lot higher. Now, it's unclear we're there yet, but as soon as the market starts to sense that, I think equities are going to really take off. In terms of where we are right now, a typical bear market rally is up about 12%. That's kind of where we are right now. And so what happens going forward is going to be very interesting. We really want to see the S&P hold above its 50-day moving average. Right now, it's about 3% above that. It's about 8% away from the 200-day. If it can stay above that 50-day, we're pretty optimistic. However, if it was to pull back and break that 50-day, we would then expect a technical retest down to those June lows around 36, 36.
Right.
I think what's been most surprising so far for investors is that earnings season has been better than expected. It's been better than people's worst fears. We've had about 36% of the S&P reports so far. 74% have beaten. So that is, I think, better than what people were worried about. I will note, though, that forward estimates for 2022 and 2023 are coming down. Mm-hmm. So the out-year numbers are being reduced, but they're still showing growth. And I think, and you look at the reaction on stocks like Microsoft and Google today, you can see the relief that earnings are not really collapsing.
Totally agree. We get two big readings on both Apple and Amazon tomorrow. And speaking of Apple, just crossing the Bloomberg terminal, Apple has enlisted one of Lamborghini's top car development managers in a sign that it is stepping up work on a self-driving electric vehicle. This is according to people with knowledge of the situation. Luigi Taraborelli, he's a 20-year veteran of the Italian car maker, so he's going to help lead the design of Apple's future vehicle, according to those in the know. So, folks, if you didn't know it, the EV race, it is on.
Yeah, don't expect to hear anything on tomorrow's earnings call about this. Apple has certainly kept it under wraps. Hey, Randy, I want to get back to the Fed and what happens if
Sure.
we don't see inflation come down, because we got 2 months. We got 2 months until the next Fed meeting. We're off in August, and they go to Jackson Hole, and we'll hear a bit. But at the same time, we're not going to get a policy decision for 2 months.
That's true. Obviously, inflation is still running very hot. The CPI was 9.1 in June year to year. And Powell made a point of calling out PCE as the Fed's most watched measure. That was 6.3% in June, the largest in 40 years. So I do think we have to start seeing these inflation numbers move in the right direction. They don't have to go immediately to where the Fed wants them, but they've got to stop going up and maybe start to go down a little bit at the margin. I'm hopeful that last month was the peak inflation month. We have seen a little bit of a decline in both food commodities and in energy prices recently. That should translate to a less hot number in July and hopefully August. But you're right, and he was very clear in the press conference. If the numbers come in hot in July and August, you could be looking at another 75 basis points in September. Right. The market would not like that. That's what could set up a move back towards that 36 low. But I'm optimistic that's not going to happen. We're going to see a little bit of an improvement, and the market can keep grinding its way higher as long as there's no surprises.
Yeah, those inflationary pressures, it's something we're going to be putting to the Chipotle CEO, Brian Niccol, whether or not, I'm trying to get an idea. We do hear some easing in some of those inflationary pressures, but what he is seeing, because they have certainly seen wages go up at that company, and whether or not they continue to see it. So, Randy, where don't you want to be in this market right now?
I think that's a tricky question. I think where I want to be is really looking to pick up secular growth stocks where I feel very good about their prospects long term. And I'm not trying to really play a strong economy scenario. I do think the economy is weakening. I would say one thing we should focus on is housing. Obviously, the pending home sales numbers were very bad. New home sales are bad. Housing is about 18% of the U.S. economy. So it's got a big impact across the whole spectrum. And so I don't think I want to be playing for a strong economy right now. What I really want to do is just pick up growth stocks but have pulled back dramatically because when this tightening cycle ends, you're going to get a PE expansion on those names, and I think you're going to be very happy you own them in 2023.
Interesting. So you mean like an Apple, an
That's what I was gonna
Amazon?
ask.
Is that what you're talking about, a Microsoft? Is that what you mean?
I mean, I do think, a stock like Google, for example, has a little bit of an easier story right now than Amazon, where they're slowing consumer spending. With regards to Apple, I think a lot of that has to do with China. They get a lot of their sales in China, and I think there's a question of how those sales been given the lockdowns we've seen in some of the major cities over there. Obviously, longer term, we really like it.
Right.
But I would probably try to be looking for companies where the story was a little bit easier, a little bit less controversial, where maybe the numbers have come down slightly, but it's been more of a valuation pullback.
Right.
Obviously, valuations were stretched. But when you look at the market right now, it's trading about 15 times the 2023 estimate of 264.
Right.
So I think this is a good time for long-term investors to start to accumulate stocks.
Yeah.
And again, once we get to the end of this rate cycle, I think equities are going a lot higher.
Yeah. All right. Great stuff. And it's interesting what you said about housing. Diane Swank earlier on TV, she's over at KPMG. She's the chief economist. She said, housing is the canary in the coal mine. It's not singing anymore. Randy Watts, so great. Chief Investment Strategist at O'Neill Global Advisors, joining us on the phone. Right now, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to this Fed Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And about 2 minutes away from the end of the trading day, Caroline Hyde, Katie Greifeld, Sonali Basak in for Taylor Riggs. We are counting you down to the closing bell and here to take you beyond that bell with a global simulcast. As with always, Carol Massa, Tim Stenovic bringing together our TV, radio, and YouTube audiences. And we passed some pretty crucial moments of the day, and it was Fed front and center.
Yeah.
And it feels as though the market took it as a dovish tone coming from Chair Powell.
Yeah, what's interesting, though, some analysis is, though, wait a minute. Bill Dudley on TV earlier, former head of the New York Central Bank, Federal Reserve Bank, is saying specifically, don't forget that Jay Powell talked a lot about, though, the June dot plot. That's pretty aggressive in terms of what we still expect to get from the Fed, and that's still their mission, bottom line.
And perhaps investors optimistic of, repeated questions and a few answers from Jay Powell about the U.S. not currently being in recession. I think currently being a key word there, but Powell talking up the strength of the labor market. I think, we talk about a dual mandate here. It certainly seems like there's one mandate for this Fed, and that's to get inflation down.
Absolutely. It seems like the full focus is on fighting inflation right now. Really curious to look at this stock market reaction. We've had 4 rate hikes in this tightening cycle. The S&P 500 has ripped after each and every one of them, but the last 2, the next day was a leg lower. So we'll see how much conviction is behind this.
Yeah, we are still looking at a NASDAQ that is on track to close with the biggest jump since at least November of 2020, if not April of 2020 at one point. So you're looking at the market really shrug off a lot of the fears when really we have a lot of data coming up ahead, including that massive GDP print tomorrow alone.
And some former Fed chairs who happen to now be heading up the Treasury speaking after it. I'm sure we'll all be attuned to what Janet Yellen has to make of the GDP print tomorrow. All eyes, of course, on JOLTS data, on various data, and of course, earnings after the bell as we get the micro data on what's happening with jobs and the response from corporate America to higher rates. Today's response to higher rates is the S&P 500 goes higher, 2.6%, 102 points added. The NASDAQ more than 4% higher, 469, and the Dow Jones up 1.4%. Russell 2000, it climbs, but Tim, I think we have some breaking news.
Yeah, I'm watching Qualcomm. The company saying fourth quarter revenue coming in between $11 billion to $11.8 billion. That's slightly below estimates of $11.92 billion. Fourth quarter revenue forecast missing estimates here. The company is seeing third quarter EPS, or $2.96 versus $1.92 year over year. Estimate was for $2.86, so a beat there on that line. Adjusted revenue coming in at $10.93 billion. That beating estimates too. So beating on the top line and the bottom line for the most recent quarter estimate, Caroline, $10.87 billion.
Qualcomm, big exposure to, of course, autos and the auto sector there, but also really pegging itself to the future of VR, AR, the future of where the metaverse goes. And that's, of course, the company that we're going to be waiting on in a moment. But really, Qualcomm has been a company that's managed to source closer to home. It's managed to be very in control of its supply chain over the previous years. Notable, therefore, though, that it is getting somewhat punished, but bouncing around after hours. Carol.
Yeah, bouncing around, as you said, but certainly a key in terms of what we're seeing in the smartphone market specifically and what indications we're having in terms of demand and also supply chain challenges, Katie.
It is interesting to see this reaction really bouncing around, like Caroline said, down about 2.5%. Going to be interesting to see if this move holds. Qualcomm
only down 16% year to date. I mean, that's a relative outperformance.
I'm also looking at shares of Apple down just a quarter of a percentage point in the after hours. Qualcomm does have a big exposure to Apple. So sometimes people like to look at Qualcomm results as, sort of a preview of what we could get from Apple because they do supply so many chips to its smartphones.
Yeah, and I'm looking at the Qualcomm guidance here, the idea that revenue will be a little lower than initially expected. You're seeing that margin pressure again, guys, as earnings continues to go on. It's like Katie always says, is it the earnings we're watching or is it the Fed? Thank God these were after hours numbers.
Yeah, I mean, all in all, we have to note that tech has had a wonderful day, and maybe we're just pulling back a little bit after what was added to some of these stock prices on the day. I mean, Meta was up about more than 6% in after hours, so we keep attuned to therefore what the market reaction will be after hours in that respect. But I really want to understand where these companies are going in terms of slowing hiring as well. Qualcomm clearly not making it any evident, but we have heard from the likes of Meta. We have heard from the likes of Ford, which is also coming out with its earnings. Interesting what Etsy is going to reflect in terms of consumer sentiment at the moment and how they look to be looking and managing their margins.
Yeah, exactly. So certainly something that we want to know. And I think that jobs part is really important because we keep hearing from companies in terms of their hiring plans. Spirit and Air Frontier agreed to terminate their merger agreement. We know that this has been going on, for several weeks, if not several months at this point. So it looks like that Spirit announces the end of the merger. They're doing that on a webcast. Spirit Air canceling the shareholder vote on a Frontier agreement. So again, we've been seeing consolidation, or at least talk of consolidation, and it being a very popular player within the airspace, but looks like we get some finality here.
Yeah, and remember, JetBlue had come in and made an offer that actually was higher, but the question is what ends up happening, because from a regulatory perspective, investors were a little more concerned that JetBlue could pull this off because regulators wouldn't necessarily approve it.
Yeah, Spirit Air to continue JetBlue talks, it seems, Katie.
And if you look at what JetBlue is doing in response, down 1% right now. Spirit actually popped higher after hours initially, but looks like it's taking a leg lower here. I guess investors really just trying to assess what has really been a long, drawn-out saga. JetBlue continuing to fall after hours now.
Yeah, and really, these are the kinds of deals that really kills trading off a little bit here. The merger arbs that were keeping the market going. You have to wonder what kind of pain they feel or don't feel now after another deal goes bust.
And is this, again, the knock-on effect of the Federal Reserve as well? Yes, we still got some spirits and animal spirits coming from JetBlue and eyeing up Spirit, but overall, this has been a dampening on M&A, a dampening on IPO, but not really a dampening on financial conditions of late since the last Fed hike. And I think that's going to be what's so important. When you see a market rip higher like this, what does Jay Powell end up making of that when he's really trying to tame everyone's desire to be buying into these sorts of assets?
Well, and this is what's so important about the commentary that we're seeing from the C-suite following these earnings, whether they are not confident enough to continue to do deals, whether it's in the M&A space, do strategic decisions. And I think we continue to see this, although he did bring up some concerns about spending, and I think capital expenditures, and that's something we need to see, whether or not companies continue, Tim, to feel confident enough to do the spend.
Yeah, there's also the consumer side of this, and the fact that Jay Powell brought up rising food prices and people going to the supermarket and not being able to actually buy food that they used to buy with the paychecks they were getting. I mean, inflation is hurting Americans. The question is, can wages come up to match that, and can we get inflation down by using the tools that the Fed has?
Meta Platforms coming out with its numbers, and it looks like it's a beat in terms of second quarter. Facebook daily active users, 1.97 billion. The estimate moving for 1.95 billion. They're breaking out the Reality Labs. Of course, this is a company that's changed its name to focus on the metaverse. The second quarter Reality Labs revenue coming in at 452 million. The estimate was 451, so bang in line. Overall, we're seeing that they are still posting a loss, operating loss of 2.81 billion. We knew that they were going to be investing heavily and losing up to about 10 billion while so doing. Ad revenue, important, in line, 28.15 billion ad revenue in the second quarter. The family of apps revenue coming basically in line, 28.4 billion. And we are seeing that the average price per ad coming down more than had been anticipated by some 14%, Carol.
And here's the bummer, maybe, Caroline, and maybe this is why the stock's down about 3% or so in the after hours, although we're bouncing around a little bit, is talking about the third quarter revenue forecast, 26 to 28.5 billion, and the estimate was for 30.32. So that is a significant reining in terms of that outlook for third quarter revenue.
And really, we had heard from people in the market ahead of these numbers, Justin Post over at Bank of America, saying, look, the company's likely to give a conservative guidance and forecast for the next quarter. Let's talk about it with Mandeep Singh. I'm pleased to say, Carol, of course, Senior Technology Analyst for Bloomberg Intelligence, is here with us to dig into a numbers conservative forecast, decent number print for the second quarter. So what do you make of it?
Well, so I think two things stand out. One is currency will have a 6% impact for next quarter. So we knew Facebook is highly exposed because of their international revenue exposure. I think the big thing that investors are focused on is that ad pricing decline of 14%. What that shows is they're making up their numbers by increasing ad loads. So their ad impressions is okay. They're trying to pivot to Reels and showing a lot of video ads. But really, I think the way they kind of came in line with the 2Q estimates is by increasing the ad loads. And we know if users see more ads, they don't like it. They get ticked off. So
that's exactly where I was going to go, Mandeep. At what point do we sort of see, I mean, for lack of a better term, demand destruction when you're scrolling through your Instagram feed or when you're scrolling through the Blue app, Facebook, and there's just too many ads and it's not a good experience?
Exactly. So look, I think they have an engagement problem with the Blue app. Even with Instagram, their engagement seems to be going down, and they're really trying to play catch up to TikTok. Now, we know from past experience that once a product kind of loses momentum in terms of engagement, and Facebook has done that to an extent with stories and catching up with ad formats, but in this case, the problem really is they're pivoting to TikTok-style AI-based recommendations, so moving away from the social graph, and there's no guarantee that they'll be able to come up with a better AI algorithm, given TikTok has had such a head start.
And we heard from Mark Zuckerberg saying that. He is quoted saying that it was good to see a positive trajectory on our engagement trends this quarter coming from products like Reels, like our investments in AI. I mean, put this into context. How important is this when you think about, the parent platform, Facebook, coming off in terms of engagement?
Well, so look, Instagram, we know, is still quite popular. They still have that creator base. The problem is you have to look at Meta as an aggregate of Instagram and Core Blue app. Now, Core Blue app, if you back out the numbers, really is in a decline. And when I say decline, their ad impressions are going down and their ad pricing is obviously taken a hit because of all the IDFA changes. So how much can Instagram make up the weakness in the Core Blue app? I think time will tell, but clearly they are growing below inflation, so they have a growth problem here, and I don't see them turning around in terms of top-line growth anytime soon.
Hey, guys, the CFO Outlook commentary, they talk about a continuation of the weak ad demand environment, and they talk about it being driven by broader macroeconomic uncertainty. They also talked about reducing hiring and overall expense growth for this year because of a challenging operating environment. Mandeep, how much of this, though, is Meta-specific, or how much does this tell you something more broadly about our world?
I mean, all these companies overhired. They thought they would continue with that 30-40% growth during the pandemic, and there was certainly a pull forward in growth, and they hired too much. So right now they are trying to freeze hiring and do cost controls, but clearly in hindsight they overhired.
All right, we're going to leave it on that note. Mandeep, thank you so much. Mandeep Singh, of course, of Bloomberg Intelligence, and we continue to see certainly Meta trading in the after hours. We've seen a little bit of a bouncing around, but nonetheless, right now that stock is down about 4.3%. All right, that's going to do it for our cross-platform coverage. Another busy day, Fed Wednesday, lots of earnings. We will see you again, same time, same place for Beyond the Bell, right here on Bloomberg.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio and on YouTube. And as we said, a couple of big earnings reports, certainly Meta, one of the big ones that we've been talking about. The stock's still down about 3.5% here in the afters. I think largely what we were expecting, but it's a third quarter revenue outlook. The slowing in revenues was expected, but nonetheless, that's some of the disappointment.
I mean, look at the range here, Carol. The third quarter revenue outlook, it was estimated to be $30.32 billion. The company says it sees $26 billion to $28.5 billion. So that third quarter outlook really weighing on the company's stock. We did see earnings per share for the second quarter, last quarter, come in at below estimates of $2.46. Estimates were for $2.54, and then second quarter revenue did come in just ever so shy of expectations. Estimates were for $28.93 billion, coming in, Carol, at $28.82 billion.
Yeah, so missing for the second quarter, and the third quarter revenue outlook, also weaker than forecast. And again, within their, press release talking about macroeconomic uncertainties. I mean, it's interesting on a day where we just heard from Jay Powell and just reminding us that they're going to go meeting to meeting. They said, we're not going to do projections because, maybe this time is different. Like, we know it's different because inflation has just stayed, so hot for so long. It's hard to predict.
Now, a lot of companies would like to take that and not do forward guidance, right?
Yeah, I mean,
they really would. I mean, you do see companies not doing that.
And you're still getting it.
Yeah.
Right? You didn't get that during the pandemic.
Hey, we're going to talk to Mandeep Singh in just a few minutes from Bloomberg Intelligence. I want to go back to a point that he made that I think was really important. It's about ad load. It's about user experience here. And there's a real stickiness problem when it comes to Facebook's legacy app, the blue app as we call it, right? And as analysts call it, that Facebook app with just the F on it, the classic app, right? Remember, Facebook owns WhatsApp and Instagram as well. And if you are, if the company's having trouble getting people engaged on it and going through this whole redesign right now as it is, then how are you going to alienate people by putting more and more ads on there?
Yeah, I don't know, right? Like, we all get to a point where we're kind of frustrated by it all. And I also just think there's a lot that are continuing to compete for people's attentions, and it gets a little tricky. I do want to mention, I know Meta's the big one. I do want to mention Ford is up about 4% in the after hours. That was another earnings release after we got, after the closing bell. Second quarter adjusted EPS, big beat, 68 cents versus an estimate of 45 cents. And second quarter automotive revenue, that too was a big beat, 37.9 billion versus 34.52. Of course, doing that pivot, especially when it comes to the F-150 in terms of an electric version. The Lightning.
Yeah.
And so we'll look for some more updates on that.
All right, let's bring in Mandeep Singh. He's a senior tech industry analyst for Bloomberg Intelligence. He just sprinted over here from our TV studio. Mandeep, we're grateful to you because I know that we've probably had more time to look at these numbers than you have. Look, it was not a great quarter for Facebook. It missed on the top line and the bottom line, and that third quarter revenue outlook is really, really light, sending shares lower in the after hours. What are your takeaways?
Well, so one is Facebook's or Meta's exposure is more towards e-commerce and retail. They talked about how advertisers are pulling back. Clearly, there are advertisers on the travel side that are still spending on ads. Now, Meta's exposure is also very low on the travel side. So that's what you see, an affirmation of the trends that we saw with Snapchat, that being the case here with Meta. Obviously, the scale is much bigger. But I think overall, ad pricing declining 14%. I mean, you didn't even see that in 2020. Q2 of 2020, when we had the pandemic, even then the ad pricing held up relatively well. So this is clearly a bad quarter in terms of ad pricing, and their engagement is going down. So they're trying to make up for that headwind using by increasing ad loads, as I mentioned before.
So right through on the terminal says Meta reporting its first ever quarterly sales decline as economic turmoil caused advertisers to shrink budgets. Is it the economy or is it Meta?
Well, so we know search, which is the best representation of the economy, Google search, it grew 12%. So the economy isn't tanking. Yes, it slowed from the prior quarters, but it still held up. And the reason it held up is because there are advertisers who are willing to spend because there is demand for services.
Right.
I think in the case of Meta, there was a clear pull forward with e-commerce and gaming advertisers. And now they're really pulling back sharply, and that's what you see here.
And this is where a distinction between all of these companies, it's important to note. Mandeep, thank you so much, bringing us to the key points of this release. Mandeep Singh of Bloomberg Intelligence joining us here in our Interactive Brokers studio. Well, while Meta may be having a tough time in the aftermarket, Chipotle Mexican Grill, let's try it again, Chipotle Mexican Grill, in the aftermarket yesterday was soaring, and it soared in today's session, up more than 16% at its highs. And this is after the company reported second quarter earnings that topped analyst projections, the chain adding new locations. Consumers showed that they were willing to show up and pay more. The company also provided an upbeat sales outlook. So great to have back with us.
We got with us Brian Niccol. He is the CEO of Chipotle. It's good to have you with us, Brian. How are you?
I'm great. Yeah, thanks for having me, guys.
Yeah, thanks so much for joining us on this. Hey, Carol went through some of these. We also want to mention that same-store sales growing in the mid to high single digits in the third quarter. That's the outlook that you gave. What worked so well this past quarter, as we're sort of getting a tale of two different earnings reports at this point? What worked so well for you guys?
Well, fortunately for us, our customer mix definitely over-indexes with higher income. And we saw that group actually increase their purchase frequency with us, and their spend was also a little bit up. So what we concluded is we've seen some trade down, and people are switching some occasions into Chipotle. So we feel like we're gaining market share for our company. And then at the same token, we did see a slight slowdown with the lower income consumer from a purchase frequency standpoint, but not in their absolute spend. And the thing that was really powerful for us throughout the quarter is our restaurants were staffed, and our team members did a great job of servicing both our digital business, which is roughly 40%, and our frontline business, which is really accelerating as people kind of come back to normal routines. And that was really the thing that I think carried us through the quarter. And then obviously our brand has tremendous value. And as a result, we were able to pass through some pricing to offset a lot of the inflationary pressures we've been dealing with.
Brian, I got to ask you, I mean, when you saw these results coming in or leading up to this earnings report, were you just kind of blown away? I mean, even restaurant margin, which we all watch so closely because it's key in terms of measuring profitability, 25.2% in the quarter compared with an estimate of 25%. Yeah. I mean, as the numbers were coming in, and were you just kind of blown away by the outperformance, considering the declines we've seen in consumer sentiment and so much recessionary talk?
Yeah, look, I really think it goes back to the strength of both our teams that are executing in our restaurants, because they're the ones that turn the top line into the bottom line based on how they perform in the restaurant. And then I think I would say the strength of brand, which is, it's really based on great culinary, great ingredients, customization and convenience. And I think we did a great job of executing against all those markers. And as a result, we were rewarded with people's business that then our teams did a great job of executing so that it flowed to the bottom line. But yeah, I'm really proud of the results, to achieve a 10% comp and also be able to, deliver the margins at the restaurant in this environment. I think it speaks a testament to just the value proposition, the strength of the brand, and the strength of the people working in our restaurants.
And while analysts in the investment community were pretty happy about what they heard, in terms of your comp sales, I just want to mention another headline crossing about another company, Best Buy, talking about their second quarter comp sales, and they're talking about them declining about 13%. So a different company, but this stock is now down about 5% in the after hours.
Hey, Brian, back to Chipotle. Let's talk about wages, because I know that we heard from you guys last night that labor costs for the quarter were increased about 30 basis points from last year, 24.8%. You did that, wage raise last year, that sort of widespread wage increase. Are you going to have to do that again?
We are continuing to see pockets of, needs to do still movement on our wages. The good news for us is we took a really big move about a year ago, which you mentioned. And then really what we've been doing is just monitoring kind of at the local level what's happening with wages and opportunity at our company so that we can attract, retain the right people. And we still are dealing with, like I say, pockets of challenges on that front.
Where are those geographical pockets?
Yeah, it's almost, it's like store by store. It's not contained to one region over another region. It really depends on what I would call kind of the market area. And, there's a lot of dynamics that go into it. Is there big box retail nearby? What are the other alternatives for kind of the employee pool that we compete with?
So while you raised wages pretty much across the board last year, Brian, not necessarily you will have to do the same thing this year, or you might have to.
No, we're still moving forward with merit increases, and we did a little bit bigger merit increase than usual given the inflationary environment, because we don't want to fall behind on wages either, given the environment we're dealing with. So that's really important to us. So I should probably caveat, we're trying to run our wage program on more of a, system basis where it happens every 6 months. We reevaluate wages, we pass along merit increases, and also we provide promotions for folks. And, before we were having to come in between those because, the competition to get labor to work had really increased dramatically because there were fewer people applying. Luckily, that seems to have gone to more of a normal pace where applicant flow, as well as our ability to then retain people, is starting to get more, I would say, to a normal approach for us, or normal run rate.
I got to ask you, only because it's been another story that we've been following for the last few months about unionization that we're seeing certainly among, restaurants. How do you guys feel about that? Or is that part of your move to make sure you stay ahead of when it comes to higher wages? Because would you prefer that your restaurants don't become unionized, or are you okay about it?
Yeah, look, I really don't see the need for a union at Chipotle. I believe our jobs and the culture and the opportunities are best done within our restaurants and within our company. We don't need a third party to be a part of that conversation. And the reason why I say that is we've got great wages. They're great jobs. We're a growth company. You have the ability to join our company with, a high school degree or some equivalent. And also, if you talk to any new immigrants or refugees, this company delivers jobs that deliver the American dream. And I can share many stories where, I was just with somebody that was a refugee from the Congo. He's now one of our highest level general managers, making 6 figures, leading a multi-million-dollar restaurant, a team of 30 plus people. And the guy is electric. And you know what? He's going to be able to continue to grow with us.
Yeah.
There's a young woman, she immigrated from Chihuahua, Mexico, single female, didn't know English, learns English. 9 years later, she's our top restaurant general manager in the entire company.
That's impressive.
So,
yeah,
there's just tremendous opportunity for people to go from a crew position, work their way up to being a general manager, becoming what we call a restaurateur, which is our top general managers, becoming a multi-unit leader. Right. And when you're building 300 plus restaurants a year, there is so much suction for people to get promoted and moved up. I think last year we promoted, 19,000 people.
Wow.
So just tremendous opportunity. And, I'm very proud of our company and I'm very proud of the jobs that we provide to our people.
Hey, Brian, a lot, though, still out of your control, especially when it comes to costs. And this is something that we heard Fed Chair Jay Powell talking about, the rising costs across the board, especially for food. We did learn last night in your earnings report that you mentioned avocados, dairy, tortillas, some packaging. Those prices are still going up. You did, though, say that other parts of the business you've seen prices plateau. What is that? Where has inflation been transitory in your business?
Well, yeah, don't mistake that for transitory because it hasn't gone backwards, right? So
you're not ready to call peak inflation?
Not ready to call peak inflation yet.
Okay.
I wish I could, but I'm not ready to say that because we haven't seen anything really go backwards yet.
Yeah.
The good news is we finally had I don't know if you can call this a trend, but we had a month or two where we didn't see everything going up. But as you mentioned, we had some major inputs going up still, and in a meaningful way. And that's why, unfortunately, we got to take another price increase in August. As much as I hate to do it, we're fortunate that our brand has the pricing power to do it, and we can maintain the integrity of our value proposition.
What ingredients are you referring to? Was it chicken? Was it steak? What was it?
That plateaued or continued to put pressure?
that plateaued.
It was more in the proteins, so like pork, beef, and some produce items. Unfortunately, packaging, aluminum, dairy, tortillas, avocados, chicken continue to have a lot of pressure.
One thing I wanted to ask you about, Brian, you're continuing to grow in terms of the number of restaurants, and especially
stocks are headed up a lot higher. Now, it's unclear we're there yet, but as soon as the market starts to sense that, I think equities are going to really take off.
And today we did see the S&P take off, up 102 points, higher by 2.6%. Dow Industrials up 436. That was a gain of 1.4%. NASDAQ Composite Index also rallied today, up 469 points. That was a gain of 4.1%. 10-year 2.78%. The 2-year yield 2.97%. Spot gold up $17 the ounce to $17.35, a gain of 1%. Bitcoin surged today, up 8.5%, 22,759 on Bitcoin. West Texas Intermediate crude up 3.3%, 98.19 a barrel. Meta platform shares are trading a little changed right now after hours, after earnings. Meta Platforms, of course, the parent company of Facebook and Instagram, reported its first ever quarterly sales decline as economic turmoil caused advertisers to shrink budgets. Mandeep Singh is a senior tech analyst with Bloomberg Intelligence.
I think in the case of Meta, there was a clear pull forward with e-commerce and gaming advertisers, and now they're really pulling back sharply, and that's what you see here.
And today, one of the biggest winners, Chipotle Mexican Grill, rallying 14.7% after earnings. We just talked with CEO Brian Nickel about the quarter moments ago, right here on Bloomberg Business Week.
You know, the thing that was really powerful for us throughout the quarter is our restaurants were staffed, and our team members did a great job of servicing both our digital business, which is roughly 40%, and our frontline business, which is really accelerating as people kind of come back to normal routines.
And Nickel did tell us that Chipotle will be taking price increases in August. Apple has enlisted one of Lamborghini's top car development managers in a sign that it is stepping up work on a self-driving electric vehicle. This is according to people with knowledge of the situation being reported by our Mark Gurman. Apple, which reports earnings tomorrow, up 3.4% today. Recapping, 10-year yield 2.78%, S&P up 102, up 2.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Gotta say, my stomach's churning a little bit because shares of Meta, man, they've been bouncing around in the after hours, still down about 1.6%, but I saw at one point that they had kind of come up to almost just like a slight loss. So investors continuing to go over those earnings.
Buckle up, okay?
Buckle up.
That's really what it comes down to.
Exactly.
Let's bring in John Ehrlichman. He's the co-host of Bloomberg Markets on Bloomberg Television. John joins us this afternoon on the phone from Toronto. John, I want to keep diving into Meta Platforms with you. As we mentioned, the company missed in the most recent quarter on the top line and the bottom line. And then it was really the guidance for the third quarter that I think has investors spooked, coming in really light versus estimates. What are your key takeaways?
Well, I think Charlie highlighted the macro story that has been playing out, Tim, all earnings season. The fact that advertisers are going to start to get a bit skittish, even if, the likes of Meta already have a large stable of advertisers and might be in a better place. I mean, who knows at the end of the day, but maybe in a better place than some of the other players out there, whether it's a Snap or a Twitter. But I think there are a few legs to the stool. And when advertisers are willing to pay money outside of the economic conditions, they're looking for reach, they're looking for scale. And we've talked before about Apple's privacy changes, which in many ways are changing the story of Meta's ability or Facebook's availability to track users as they may have in the past. That's probably a good thing for people concerned about privacy, but it could have a little less of an impact on the advertising side. And then everybody's been talking about the continued rise of TikTok. And I think when it comes down to engagement, even if you've got as many users, as many eyeballs as Meta has, the hot game in town is the one that tends to start to get a lot of advertiser attention, marketing officers who are told, well, how come we aren't looking more at TikTok versus, let's say, Instagram? And I think that kind of gets down to it.
We spoke with Mandeep Singh over at Bloomberg Intelligence a little earlier, John, and he mentioned the idea of ad load and Facebook making up for weakness in terms of ad pricing with basically ad frequency. And I'm wondering about alienating us, the end users here, and to what extent, if we just open Instagram or open Facebook and it's all ads, it further turns us away at a time when they're having trouble keeping these apps sticky.
Well, this is going to be the interesting twist because we're talking about a company that had its stock price, lose half of its value this year coming into these earnings. And there have been a lot of people that have been looking at the math of Meta, the fact that this company has boatloads of cash, upwards of $40 billion, I think they just reported now. They just told the street that their expenses for the year are actually likely going to be less than what they previously had forecast. And if you go from the bottom end of their new range versus the top end of their previous range, that could mean $7 billion less in spending. And then coming back to the user experience, Tim, ultimately, if they are finding ways to focus their spending this year on making the product better for advertisers, as opposed to all that spending they previously were going to do on the metaverse, this is kind of the recipe for the stuff that investors generally get behind. So it's going to be that balancing act, I think. Yes, maybe there are some concerns on ad loads for you, the user, but this could end up being an encouraging sign for investors for a really hard-hit stock.
John, I do think about in terms of the ad spending, how we compare, because one thing we did talk about with Mandeep is comparing what Google had versus what we got from Meta, and Google seemed to do okay, and I guess it speaks to who are Meta's customers versus who are Google's, and we need to think about that all these companies, despite talking about ad spend generally, we have to remember exactly the markets that they're playing in.
Very true, very true. And I think, one of the takeaways so far in earnings season, people use the example with Microsoft too. It just feels like if you've got a tech business that has a wider coverage of business units, Microsoft, having exposure to ads through LinkedIn, but that's not the whole pie. At the end of the day, I think coming into this quarter, we knew there were going to be some challenges, and Meta basically confirming that. And so there is going to be that near-term concern on the revenue year over year being lower for the first time in history. We got so accustomed to those top-line beats and growth from this company. By the way, it was earlier this year that we started to see for the first time the user numbers creeping down. So I think that the story of Meta as a value play is getting attention from investors. Wow. The longer term story is still that metaverse interest.
Incredible.
So we'll see what happens on that front.
Yeah, right. Okay, hey, 30 seconds left, John. Where does Apple fall in on this? Is this basically, did Apple, is it too early to say that Apple led to the destruction of Facebook?
Well, I think it's definitely, if we want to put it into thirds right now, the economy, the TikTok competitive pressure, and then the Apple privacy reality, absolutely, it's playing a role here. And we'll see what Apple says this week about the privacy story. But let's also wait to hear what Meta has to say on their earnings call. Could provide a little bit more color on where exactly that pain point is sitting right now.
So much great information. All right, John, thank you so much. John Ehrlichman, co-host of Bloomberg Markets on Bloomberg TV, on the phone from Toronto. Meta shares still down about 1.8% in the after hours, but definitely off some of the earlier lows. Also following earnings, Ford, it is up more than 6% in the aftermarket. Best Buy, which also came out and said second quarter comp sales to decline about 13%. We're seeing that stock down about 3% in the after hours. And Qualcomm out with their results, and they're down almost 4% in the aftermarket, Tim.
All right, well, let's get a check of world and national news.
Thanks, Tim. You have been hearing it here on Bloomberg. The Fed announced its fourth interest rate hike of the year, today bringing the rate up another 75 basis points in hopes of lowering near historic inflation while avoiding a recession. Fed Chair Jerome Powell.
I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well.
Powell did admit inflation, which was 9.1% in June, is still way too high. President Biden had some good news to share today.
I've just tested negative for COVID-19 after isolating for 5 days.
Biden used the Rose Garden appearance to promote booster shots, saying that's what prevented him from becoming seriously ill. Secretary of State Antony Blinken says he intends to speak with Russian Foreign Minister Sergei Lavrov in coming days, and he says the U.S. has offered a substantial proposal for the release of imprisoned American citizens, Brittany Griner and Paul Whelan. Well, the Senate has passed legislation that includes $52 billion in grants and incentives for U.S. semiconductor manufacturing.
The yeas are 64, the nays are 33, and the motion to concur with an amendment is agreed to.
The bill is expected to pass the House later this week, then move to President Biden's desk for his signature. A grand jury has indicted the man accused of opening fire on a 4th of July parade in suburban Chicago on 117 felony counts. 7 people died, 30 were injured. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master along with Tim Stenovic. We know the big earnings today is certainly Meta, and we are seeing that stock continue to trade lower in the aftermarket. It's still down about 1.5%, really, as that company talks about the forecast and reporting its first ever quarterly sales decline, but also giving an outlook that really reined in some of those sales numbers.
All right, we got some other numbers too here, Carol. I want to talk Best Buy. Best Buy shares are down about 3% in the after hours. They were down significantly more than that just a few minutes ago. It dropped 11% earlier as second quarter comp sales were set to decline about 13%. The company sees second quarter financial results below the expectations that were shared back in May. The company said it will actively assess actions to, quote, manage profitability.
All right, and then I want to go to Ford because this one has been rallying in the after hours. Let me just bring it up on my Bloomberg. And if I take a look at Ford, it's now still up about 5% here in the aftermarket. The company's shares jumping after second quarter. Profit and sales blew past estimates. So we're talking about an adjusted EPS estimate. When it crossed, I was like, what? 68 cents versus 13 cents year over year. The estimate was for 45 cents for the quarter. So you're talking about 23 cents better than what the street was expecting. Total revenue was almost $40.2 billion. Automotive revenue was up 57% year over year. And the company, talking a little bit about getting ready for moderation in pricing as the supply chain improves.
Okay.
Sees
That's
commodity costs easing in the second half. And says dealers have only a 14-day supply of vehicles. They also...
Carol, this is just weird. We're in a weird place right now.
Yeah.
You got Target and Walmart coming out and saying what they're saying, Best Buy, and then you got this from Ford. You got Chipotle saying that the higher-end consumer is powering the company. I mean, in your words, right, firing on all cylinders.
Right, exactly. So it's kind of like, I think it depends on the company, depends on the environment. The company, though, has begun some cost-cutting efforts. We're talking about Ford again, and they did not talk specifically on how many jobs will be cut. But again, as they continue to focus more on EVs, right, we see these auto companies adjust.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Big day for the U.S. stock market, a Fed Wednesday. The Dow, the S&P, NASDAQ all ripping higher. Today's stocks rallied, bond yields fell. As Jay Powell said, the Federal Reserve will slow the pace of rate increases while adding that officials will refrain from offering clear guidance on the size of their next move. So here's where we ended the Wednesday session. S&P was up 102. That was a gain of 2.6%. Dow Industrials higher today by 436 points, a gain of 1.4%. NASDAQ up 469. For the NASDAQ Composite Index, that was a gain of just about 4.1%. 10-year yield, 2.77%. The two-year yield today, 2.97%. Spot gold up 1%, $17.34 the ounce. West Texas Intermediate crude up 3.4%, $98.18 a barrel. Big day for Bitcoin, surging by 8.9%, $22,802 on Bitcoin. Meta platform shares lower after earnings. The parent company of Facebook and Instagram reported its first ever quarterly sales decline. Shares moving lower by 2.7%. Briefly, we're keeping an eye on Ford shares after hours. It reported adjusted EPS for the second quarter that beat the average analyst estimate. Shares surging 10% after hours. So again, recapping, big day for the U.S. stock market today. S&P was up 102, a gain of 2.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
That's jam-packed, full of corporate news. All right, Charlie, thank you so much. So we know during the pandemic that a broader clientele was boarding private jets, especially as business travel came to a halt. And we've got a great guest to give us kind of an update as how the private jet industry continues to evolve as we increasingly come out of the pandemic, but we're not done yet.
We are certainly not done. A good reminder that we are still in it, right? The president just testing negative today. Andrew Collins is president and CEO of Sentinel Jet. He's with us right now in the Bloomberg Interactive Broker Studio. Andrew, it's been a while since we've seen you. It's good to have you back with us. How are you?
I'm doing great, and it's great to be back here in the studio.
Great to have
Thanks
you.
for having me.
Hey, give us, I want to talk about sustainability and what you guys are doing there because there's some really cool stuff. But first, I want to get an idea of what you're seeing as you look across the landscape right now. And to Carol's point, we saw private jet travel demand really shoot higher during the pandemic as people, thought that this was a good way to keep them safe. Are you seeing that demand remain strong right now?
We are. So we saw the addressable market expand per se, right? A lot of hidden people, hidden customers that, really took a pandemic to bring them out. They might have been a little fiscally conservative or they might have thought about the sustainability issue, but at the end of the day, they came out. And products like ours, we invented the jet card, so you pre-buy 25 hours at a time. When you utilize a service like that, you tend to get used to it. And so I don't think all the new entrants that came in and the expanded, amount of and the velocity by which, the volume came, I don't know that will remain exactly as it stands, but a good portion of it is we're very busy this summer. Despite, raising rates and fuel surcharges and everything else, there is a voracious appetite for flying and traveling right now.
Are you back to pre-pandemic levels?
We are well past pre-pandemic levels.
Really?
Yeah.
And is most of it leisure, or is it a combination of leisure and business?
Little tricky because it feels like leisure.
Or what do they call it now? What is the hybrid?
Bleisure.
Where like,
Yeah, I think it's a lot like that. Yeah,
like I go on a business trip and I bring my husband.
100%. Yeah. I think that it used to be I could tell you it was 60% corporate and it was 40% leisure, et cetera. Now it's very much hard to track because it's a lot of individuals, a lot of individual flying. They might be just expensing it. You have no idea in some cases. You'd have to look at kind of time of day and where they're traveling.
What do you mean you don't know? I mean, a corporate credit card goes through, right? Doesn't it? Like,
well, because when you with our card, you actually deposit money and then we just debit it down. So we'll never really know if you're using it for business or not unless you did set it up as a business account. Okay.
Right.
But
because somebody pays for it, right?
Somebody does pay for it, yeah. And and a lot of times it's a primary customer and it's in their name. So at the end of the day, though, you can tell certain routes and you can see things come back. Teterborough's come back a lot. Westchester's come back.
Right.
Van Nuys has come back. So there's a lot of business travel out there that's almost sneaky, but it's definitely happening.
It's interesting. We're seeing this reversion to the mean with a lot of these pandemic plays out there in the public markets, whether it's Shopify laying off 10%, 1,000 people earlier this week. Peloton coming back from sky-high valuations. Do you anticipate a reversion to the mean as we do ease out of the pandemic and you get back to pre-pandemic levels, which were significantly lower than they are now? People become more comfortable on commercial travel?
Well, I think that commercial's got a long way to go, and that's, without disrespect to my commercial brethren, but...
Oh, you can disrespect. We've had to do a bunch of commercial flying.
We spent a lot of time disrespecting
it. Yeah. It's been a bummer.
It's tough, right?
It is tough.
The reaction up front was to shrink a lot of routes and shut a lot of things down. To bring that back is really tough. So they're in the process of trying to figure that out. But there's a lot of people that left the airline industry, and they're not coming back, or pilots and crews retired. So there's a lot of challenges there. Over in Europe, it's even worse. So right now, you're seeing private jets 15% year-over-year growth due to the fact that it's just very difficult to travel throughout Europe. And no, I don't know that I see a lot of return yet. It just doesn't feel like that. It feels like in the fall and in the winter, especially this peak period, we're gearing up for a very big peak period during the winter.
Do you have all the workers that you need or that you want? Or yes, but you're paying up for them big time.
You have to be very aggressive.
Yeah.
So we've done a lot of aggressive work. We've done a lot of recruiting. We've hired a lot of recruiting
Aggressive
people.
means you're paying them more.
We're paying them more, and we're talking to a lot more people. It takes a lot more to fill one slot, so we're doing a lot. We're also doing
But
things...
not everybody can be a pilot.
No, not everybody can be a pilot, and so there's a lot of work that goes around being a pilot, but to get crews, for instance, you have to pay more, no question.
Hey, Andrew, I want to touch on the sustainability efforts.
Sure.
You mentioned people who have been previously concerned about the environmental impact of perhaps traveling private might not have the same concerns now. It does emit a lot of CO2. I mean, we're talking tons and tons per single plane per hour, literal tons. What are you doing to offset that and to kind of make customers feel better about their environmental impact?
So you have a lot of different choices. You can do nothing, and people will still pay and come on and fly. You can do a simple carbon offset, or a lot of people will offer access to a carbon offset service or something like that. We actually don't charge our customers, and we do 300% offsetting. So we invest millions of dollars in the background to do emissions offsetting. So we go a little bit further. We go into the water vapors, the aerosols, the nitrous oxides, the things that actually make the difference. I would argue that we probably are doing one of the largest sustainability efforts in private aviation. And so we do it with a partner, but it's not an additional cost to our customer, and every flight is offset 300%. So in the first half of the year, we probably did the equivalent, if I was to compare it to things, it's the equivalent of planting 5 million trees or providing energy to your average town in America for a full year. It's a lot, and we're just getting used to it, and we're just learning it, and we're just experimenting with things, but we're trying to push our industry to do a lot more.
I agree. Push, push, push away. I love carbon offsetting. What about carbon negative efforts, where we're actually reducing the carbon in the atmosphere, which many would argue that that's what we need to do to save this planet?
I think that you've got to look at a lot of things. You've got to look at sustainable aviation fuel. I think you've got to look at a lot of ways to, one of the offshoots of the pandemic that's great is that it's virtual. So you're not doing a lot around the office as much and things like that. So we're looking at a lot of different ways to handle sustainability. I would tell you, though, the biggest push that can happen is in electric and what they're calling eVTOLs. And, as a company, we have 200 eVTOLs on order for both, Europe and North America.
When do you get those?
I hope, knock on wood, in 4 to 5 years.
Wow. What's the company that you've ordered from?
Eve.
Okay.
But is it eventually your whole fleet? Just got about 20 seconds.
I don't know. It could be. It's definitely a mass transit play, but it's definitely on the horizon.
But you're feeling the pressure to do that too, right?
No, I think we're ahead of the curve, to be honest with you.
Love it, love it. So glad you went there, and so glad you're working on that. Andrew, great to have you in studio.
Great to be here. Thank you.
Andrew Collins, he's president and CEO of Sentient Jet, joining us here in our Interactive Brokers studio. Wow. It's only
Big
Wednesday.
day.
It's only Wednesday, Lemon.
Sneeko data later this week.
Important employment cost index, GDP, inflationary data.
Hey, are we in a recession?
Jay Powell says no.
Okay.
At least for the moment. Meta platforms, lower in the after hours. We're going to watch that tomorrow. And then Amazon and Apple tomorrow. It's a lot.
Big day.
All right, for the Business Week team, have a great and safe evening.